More student loans in the news as we talk about new federal student loan limits that might shift profitable loans to private lenders. Very interesting topic today. Before we get to it, you can always dive into any topic we talk about on the podcast deeper and deeper as you take a look at the article associated with it at thecollegeinvestor.com. That's where you want to go for pretty much anything that has to do with student loans and really money in general. We have tons of tips for you. Anywhere from how to pay back your student loans to how to get a side gig that can turn into a full-time gig. It's all there at thecollegeinvestor.com. Also, like us, follow us, share us, thumbs up, whatever else we do on social media. You can find us, just search for the words The College Investor. Okay, let's dive into this. New loan limits. At first glance, the Trump administration's push to privatize federal student loans might look like a political calculation. No, the economics behind the recent policy changes tell a little bit of a subtler story. And by the way, this is not a right-left show today, okay? We're not leaning any way. We're going to try to stay right in the middle, right in the center, and just do the facts, okay? All right, let's get to it then. Under the One Big Beautiful Bill Act, or OBA, I'm just going to call it OBA from now on, the administration's sweeping higher education and tax package, the federal government is tightening who can borrow and how much through plans like the Parent Plus and Grad Plus programs. These loans have long been among the government's most profitable, often taken out of creditworthy parents by creditworthy parents. My parent actually did that in the middle of or late stage of their careers, or grad students pursuing high-paying careers like medicine and law. Now, there are new borrowing limits and the elimination of Grad Plus altogether for future students. That's kind of changing the dynamic of things. Families and graduate borrowers who once relied on federal programs for large sums might soon find themselves turning to private lenders instead. It's a structural shift. It accomplishes, in practice, what privatization would have done politically. It moves the most lucrative borrowers and the profits that come with them into the private market, while leaving the federal government with the less profitable parts of the student loan portfolio. The government's supposed to serve the people, not profit from the people, is kind of what I'm gathering here, right? So let's talk about the new borrower caps that start in 2026. Under the OBA, major changes are coming to federal student loan programs. For example, starting July 1st of 26, Parent Plus loans will be capped at $20,000 per year and a $65,000 lifetime cap per dependent student. Previously, parents could actually borrow up to the cost of attendance, minus other aid. Seems kind of crazy. Anyway, the Grad Plus loan program for graduate and professional students is being eliminated for new borrowers, and in its place will be some new limits on direct grad loans of $20,500 per year and $100,000 lifetime for most grad students, and up to $50,000 per year and $200,000 lifetime for professional programs like law or medicine. At the same time, the federal repayment options are being narrowed, and protections are reduced for new loans. Parent Plus loans can only be repaid under the standard plan, while new graduate loans will only have access to standard or the new repayment assistance plan, RAP. In other words, after July 2026, for new borrowers, parents and grad students will face tighter federal borrowing terms. And for parents specifically, there will be no pathway to public service loan forgiveness, PSLF. That's for parents, not for the student. Student, yes, PSLF is still there. Okay. Here's where private lenders benefit from this. Now we get into the economics, nuts and bolts here. Historically, Parent Plus and Grad Plus loans were among the most profitable segments of the federal student loan portfolio. In 2024, the government made $2.76 for every $100 in student loans it lent out in Plus loans. Woo! Cha-ching! It was the only segment of the portfolio that was actually profitable. And the overall student loan portfolio lost around $20 for every $100 it lent. Back in 2018, Parent Plus loans were delivering over $30 in profit for every $100 lent out. That's crazy. With the new caps in place, the feds are deliberately shrinking its exposure to these more profitable borrowers. So the logic goes, parents who need more than the new limits are going to turn to private loans. Grad students in expensive professional programs likewise will seek private loans if federal caps fall short of what they need. Man, if you need more than $200K, shoo! But as we said before, this shift could lead to a rise in private loan use among grad students, especially in fields with high tuition, under the OBA. From a policy perspective, that means the government is pivoting. It keeps the higher risk, lower return loans in-house under federal programs and pushes the lower risk, higher return business to private lenders. Here's why this reduces the push for full privatization. The Trump administration has talked about getting out of student loans completely and letting private lenders take over. These baby steps in the OBA kind of make that a less desirable outcome for banks, right? The law limits how much the government can lend to the kinds of borrowers who usually repay their loans in full. Parents with steady incomes, for instance, or grad students who become doctors and lawyers, right? Those borrowers are often the most profitable for lenders. Because the government is lending less to them, banks and private lenders can step in to offer those loans instead. That's good business. The borrowers who are most likely to pay back what they owe. Moves the private side automatically. This goes to the private side automatically, I should say. So what's left in the federal system are the loans that don't make any money or lose money. They carry a whole lot more risk, like those for undergrads or low-income students. Probably why the government wants to say, I'm getting out of here, right? The government keeps these loans mostly for public reasons, just to make sure college stays accessible for families who can't easily borrow from a bank. So, the government doesn't need to sell or privatize the whole thing. It's already shrinking the profitable part of it through policy and letting private lenders take over that space naturally. And banks really only want the profitable loans anyway. They're not going to want to own the loans that lose money or require more paperwork and overhead to just maintain them. So here are the implications for consumers and families. For families considering borrowing in 26 and beyond, the implications are pretty significant here. A parent that used to be able to borrow up to the cost of attendance via Parent Plus loans might now max out at $65K lifetime, which could actually be a blessing as well if you look at it from the other side of things. You probably don't want to borrow more than that when you're later in life. But now the math of Parent Plus versus private loans has changed, making private loans a little bit more compelling if you can beat the interest rate offered by Parent Plus loans. And banks are going to want to compete. These are good, profitable loans to want, so it makes sense to lower your interest rate. So for grad students in expensive programs, medicine, law, dental, all that stuff, the elimination of Grad Plus means their federal borrowing limits may be lower than their cost of attendance, which just baffles me how expensive. That gap directs them to private markets as well. Whether this shift is intentional or incidental, the fact is that more high-earning borrowers are going to end up with private loans, which means more profits for banks and potentially more risks for borrowers, while the federal system retains a greater share of borrowers who are less profitable overall. The result is this. Banks will increase profits on student loans, the federal government retains the less profitable loan segments, and overall, there is less incentive to privatize the broader loan system. Okay, so that is our show for today, and just another reminder that it was not in anybody's intention whatsoever to lean toward the right or the left. We're just staying in the middle. We're neutral, okay? That said, if you want to dive deeper into everything and find opinions, you can do that on X. You can also follow us, like us, and all that stuff on X and all the social media channels at The College Investor if you have questions, comments, anything like that. And you can dive into this article as well at thecollegeinvestor.com. Thanks so much for stopping by today, and we'll talk to you again real soon.